So I'll go on record and say there's not going to be a debt crisis. There's not going to be a debt heart attack, and it's not going to happen in the next 3 years. We're sort of in like the eighth inning of that process where the economy is now starting to look a heck of a lot like the sort of 2019 environment where you had relatively low but stable growth and you had relatively low inflation compared to the historical norm. I think the tariff narrative has been massively overblown. The amount of airtime it gets is, a lot of noise relative to the actual signals. I would probably be more inclined to take the other side of that, where, especially with the coming AI boom, or the emerging AI boom, I would say that the likelihood of low inflation, potentially very, very low inflation, is much, much higher than the likelihood of very, very high inflation.
Thank you very much for joining us again on Excess Returns.
Hey guys, how are you doing?
Great. Over the years, you've been kind enough to join us many times, and we've talked to you about a number of macro and investing related topics. I think we've covered everything from inflation, the role and the plumbing at the Federal Reserve, the banking system, and a wide variety of other economic and market related content and topics. I think the one thing that Jack and I think our audience appreciates about these discussions with you is it's kind of like trying to cut through the noise and get at what the important drivers are and the levers that are impacting the market and economy. So today we're going to kind of work through some of those big picture, I think macro related items with you, things that are on investors' mind. And then we'll also dig into your investing framework, defined duration investing, and how sort of you utilize asset allocation to construct and build that strategy, and balancing, risk and return, and talking about why that's important for investors over time. So we have lots of ground to cover today. You can go to Cullen's website where you can learn more about his firm and the various things that he's up to. That's disciplinefunds.com. So with that, Cullen, let's start out with the easy stuff. What's your current take on the overall U.S. economy today?
So I think my general framework for the last few years has been that basically you had this huge COVID shock, this huge unusual economic environment, really big unusual government response to it in virtually every way, whether it was the lockdowns, the supply chain shutdowns, obviously the huge amounts of government spending and the money printing that went on that contributed to the high inflation. And my general view has been that as COVID kind of waned, we've been basically mean reverting back to more or less where we were before COVID. And so I would say that we're sort of in like the eighth inning of that process where the economy is now starting to look a heck of a lot like the sort of 2019 environment where you had relatively low but stable growth and you had relatively low inflation compared to the historical norm. And I think that the evidence now, I think, is starting to bear all this out, where the GDP numbers now are low relative to the historical average, but they're not recessionary. They're not like frighteningly dangerous levels or anything like that. And the inflation story is similar. It's been a little bit stickier than I would have expected it to be. Just because I would have expected I did predict the disinflation and the rate of decline in the rate of inflation that's occurred, but it's been a little bit stickier than I would have expected. And that's in large part because the shelter market and the shelter component of CPI especially has held up a little bit more than I would have expected. So we haven't seen as much downside in especially real estate prices and just the general real estate market overall. It's very, very sluggish, so don't get me wrong, but it's held up better than I would have expected. I mean, for instance, if you'd asked me if real estate prices would be, more or less where they are today relative to where they were 2 years ago, I would have said, oh, the likelihood of prices being 5 to 10% lower or maybe even more nationwide was much higher than what has actually transpired. So things have been a little bit stickier than I would have expected, but I think more or less we're still in that sort of mode of we're mean reverting. We're getting there. The process is not quite over yet. We're in that eighth inning, and I think we're gonna get there.
What do you think on inflation? Because on the one hand, like you have, obviously there's the tariffs that could play a role here. You have maybe the Fed starting to ease at some point soon. And then, I have heard some arguments that elements of Trump's big, beautiful bill are stimulative in nature that could, kind of result in maybe an uptick of inflation. So just generally, what's your outlook for that?
Yeah, so I don't think the tariffs have turned out to be, I don't want to say a nothing burger, but they've turned out to be much, much smaller than what was expected. I mean, there was a period there in April where, they were talking about replacing the income tax with tariffs, which, we're talking about a $2.5 trillion line item in the federal budget, which if you were imposing those sorts of tariffs, yeah, whoa, oh boy, that would have caused some problems across the whole economy. So far, we're running at like $135 billion or so since April 2nd in total tariffs, it's not nothing, but we're talking about something that is in the range of like probably going to be 2 to 3% of the federal budget. So, tariffs were already $80 billion a year before we implemented this. They're probably going to run at like a rate of like maybe 250 to $300 billion a year. So you're talking about what is the equivalent of like roughly a $200 billion tax hike on the private sector and corporations who ultimately will pass that on to consumers or whoever they can, whether it's shareholders or workers or the people who actually pay taxes, because corporations don't actually pay taxes. But in all, I think the tariff narrative has been massively overblown. The amount of airtime it gets is, a lot of noise relative to the actual signal. So that's not a big worry for me. I think that when you look at the general inflation trends going on now, it's still largely a shelter story. A shelter is running at 3.7% year over year. The 30, 40-year average there is only like 3%. So shelter is still sort of at like the high end of its average range for the last 30 to 40 years. And I don't see any scenario in which that doesn't continue to come down. And shelter is it's such a big component of both the CPI and the PCE inflation metrics that in order for that component to come down and have overall inflation go up, you need something else just gigantic to offset that because it's such a big component of the overall inflation trend. And so I don't see that. Commodity prices have been relatively stagnant for most of the year. We got a little bit of a bump after the tariff jump, but that came right back down, which is consistent again with the idea that tariffs haven't been, all that impactful overall. And so I think that we're in this scenario where in the short term, the likelihood of inflation, being relatively low. Even 3%, people are, kind of saying that, I said it earlier, that inflation's a little bit above target. The Fed's target is 2%, but 3% is right in line with like the historical average. So we're not in a high inflation environment. We're not in a scary inflation environment. And I don't see the spark for what would cause high inflation going forward. We would need like a huge commodity bump or something like that. You would need, you alluded to lower interest rates, maybe sparking the housing environment. You need much, much lower interest rates than what we've got. We might get lower interest rates next year, but we're talking about in order to get a really big like refi boom or a housing demand boom, you're talking about you'd have to cut interest rates to 2%. And I think to justify that, to get mortgage rates down where the demand would be really high again, in order to justify those sort of rates, we're probably talking about something that's maybe recessionary type interest rate environment, which I don't see a recession either right now, but I don't see a high probability of inflation bumping up again. And so I think disinflation is kind of still like my baseline trend going forward. And I think that from a secular basis, I think that the likelihood of these big disinflationary headwinds to continue to really reassert themselves, kind of like in the pre-COVID era, I think are very, very high, just because the AI boom and then the demographic boom combined with the inequality situation, it's all a recipe for sort of a stagnant sort of disinflationary or low inflationary type of environment in the long term.
What is your, and we haven't heard this term as often anymore, but the idea that the Fed can orchestrate sort of this soft landing, it seems like, that's kind of what we had here. We certainly didn't have a hard landing, although maybe certain industries or sectors under the surface, some might argue they have been in this rolling recession. But
Yeah.
anyways, and maybe you can comment on that, but I'm just generally speaking, do you think that like there was an engineered sort of soft landing? And maybe the Fed, I'm just thinking too, like consumers were, balance sheets, household balance sheets and corporate balance sheets, maybe they were in better shape over the last few years. And so interest rates didn't affect them. I don't know. So I'm just curious on your
Well, I think that's
thoughts on
right.
that.
I think households were in better shape, balance sheet wise. Like there wasn't a big borrowing boom, pre-COVID like there was in the pre-financial crisis period. Corporations are arguably, more robust than they've ever been, from a balance sheet perspective. So, I think there's a lot of truth to all of that. I would say that, yeah, I never loved the hard landing analogy just because the economy isn't something that lands. And the way that I've sort of discussed this concept in the past is that the economy is a lot more like a plane that flies at cruising altitude. And that's what they're always trying to maintain cruising altitude. And when you have these hiccups like COVID, what happens is the Fed has to sort of divert the plane. There's an oncoming storm or you find yourself in a storm and the Fed has to divert the plane in some way. And in this sort of an analogy, the Fed, they slow the plane down. They're trying to slow the plane intentionally to, avoid turbulence or whatever it might be. And so I would say that right now, are we back at cruising altitude is really that would be the baseline that I would put us back at to say the Fed has succeeded. They can declare victory. I don't think you can say that yet, just because I do think the Fed has done much better than people give them credit for. I think that the way that they were able to raise rates and do it in a relatively counter-cyclical way relative to what the rest of the government was doing. We were still passing COVID bills when the government or when the Fed started raising interest rates. And so they were operating in this very counter-cyclical manner, and it helped snuff out inflation, mainly because they crushed private borrowing markets, and primarily the housing market and the lending boom that was going on during the early COVID period. And so I think at the same time, the Fed has done much better than they probably get credit for, but you have really meager employment growth now. And so when you look at this from the perspective of the Fed's dual mandate, yeah, they've mostly defeated inflation, although inflation is still above their target, so kind of uncomfortably high for them still. And you have a really soft employment market now. And so I don't think you can say that the Fed has completely avoided the storm here, that, and we certainly haven't gotten the plane back to cruising altitude to a point where, we were having, let's say, this looked a lot more like cruising altitude last year when you had, moderating inflation and you had, 200,000 plus jobs per month. Right now, it looks like the plane is sort of stalling a little bit, trying to get back to cruising altitude. So I think they've done better. They've done much better than expected. But the mission is not accomplished yet.
And one of the things I always love when you come on is you're always one of the first people to say like how difficult their job is. All of us like to sit here and criticize them and, it's all the decisions they've made. Like it's not easy what they're trying to do here.
They have it's an impossible job. Like I always joke that, like, if I was ever nominated to be Fed chair, which I never would be, but if I were, I would reject that job so quickly. It's got to be one of the worst jobs on the planet. You're not only getting berated constantly by the public, but now you're getting berated by everyone in Congress and in the executive branch. So yeah, you can't win.
Well, if you do get nominated, I hope you keep coming on because we'll get tons of views if we get the Fed chair on here on a regular basis, giving us analysis.
I always tell people that if I were nominated, I would walk into the Federal Reserve building with an algorithm and say, "Hello, here's your new monetary policy. I'm going back to California now."
I did pitch Neil Kashkari. He's a Federal Reserve governor. I actually pitched him personally for the podcast. He politely declined, but he did get back to me, which was kind of cool because I'm a big fan of his.
Yeah, I don't know if they can do private interviews.
They do odd lots occasionally. I think some of them don't do, right? So we're obviously not that big yet, but maybe someday for us.
I think the Federal Reserve has like its own media people that like book those things.
Yeah,
it's not like directly to the Fed governors, but just on the independence thing real quick, what's your take on that? I mean, is it, I don't know if you guys saw, like yesterday, Ken Griffin, I think it was an op-ed for the Journal, kind of came out and voiced, that threatening the independence, could undermine just the market's confidence, maybe result in higher inflation, maybe result in higher borrowing costs. Like those would be the knock-on effects of that. But I don't know, Cullen, do you have any thoughts?
Yeah, I don't worry so much about maybe things like that, but I do worry about the Fed's independence in the context of their ability to operate independently and countercyclically. Like, as I was discussing before, that's the main role of the Fed. The Fed is designed to be able to be independent in the sense that they should be able to look at the economy objectively and say, okay, we have high inflation and our politicians are printing a ton of money, and politicians, obviously, they just want to remain in office. They want the economy to look strong. They don't necessarily care too much about the, whether inflation is potentially, misaligned with the Fed's target. And so the Fed's able to come in and operate in this very independent and apolitical manner at times when it's most needed. And an example like 2022 is perfect, where the Fed's able to come in, they can raise interest rates regardless of the political noise. I'm sure the vast majority of politicians did not want the economy to slow at that point. And the Fed very explicitly comes in and says, sorry, boys, but we're going to slow the economy because we've got to get inflation under control. And that's what an independent Fed does and should do. And when you get a Fed that becomes more and more aligned with the goals of politicians, you just get the increasing likelihood that in an environment like that, maybe the Fed doesn't raise rates because the president is constantly saying, chirping in their ear that, hey, you shouldn't raise interest rates because that might hurt my potential to get reelected. And that's irrelevant to what the Fed's real goals are. And so that's the bigger worry. How realistic is that worry? I don't know. It's probably overblown, even with what Trump is doing. But at the same time, it's a real risk that, if we had objective, I think, economic thinkers nominating and approving these people who are nominated to run the Fed, you would look at it in this very apolitical, objective sense and approve them not because they're nominated by your guy or your side, but because they have this ability to be apolitical, independent, objective thinkers. And so in a perfect world, that's what the Fed would be loaded with, and traditionally has mostly been aligned with that. But there is this risk that the less and less independent the Fed becomes, the more sort of politicized it becomes. And then all government policy becomes very sort of pro-cyclical, that's the worst sort of outcome, because then you never have an environment where in 2022, the Fed is able to raise rates. I mean, if the Fed had kept rates at 0% in 2022, I think the housing market would have been on fire. It would still be on fire, I think. Like I for sure would have moved. I for sure would have bought another house. I know millions of other people who probably would have too. And so I think that their ability to act independently is one of the really important foundational policy tools that keeps the U.S. economy as robust as it has been.
I think if we've learned nothing else through this incident, we've learned that there's multiple people on both sides of the aisle that have multiple primary residents. It seems to be like every day there's somebody else that comes up with they also had multiple primary residences. So apparently that's pretty commonplace in the economy. I want to shift to the national debt because you've written about this recently, and you're probably the person I would go to talk about this because this is something obviously it's gotten the national debt is something we didn't talk about for a long time, and it's become a much bigger issue recently. And there seem to be two camps. There's the Dalio camp that we've got a coming debt crisis, maybe not right away, but sometime in the next 3 to 5 years or something like that. And then there seems to be another camp that there's no crisis coming. The consequences of this is really, potentially with rates or inflation or something like that, but there's not going to be any kind of crisis. How did you think about the national debt and what it means to all of us that are investors?
Well, this one's obviously a huge political football that you get into really the efficiency of the government. I think that's the sort of, I think, dividing line between the two sides. And there's a side that says, hey, the government has to intervene and do certain things because the private sector is bad at those things. And there's another side that says the government is always inefficient. Everything they do is bad and we need to limit it as much as possible. And, the truth is probably obviously somewhere in the middle there. There's a lot of different places where I think the government is much more effective than it is in other scenarios. And the national debt reflects that. I think that the tricky thing in all of this is when you get into a discussion about the relevance of the national debt, you're getting into a really high level macroeconomic discussion. I would argue that in an economy like the United States, where the private sector is very innovative, very productive, very robust, the impact of the government is actually much, much lower than in an economy where, like Somalia, where the private sector is very small, and the impact of government money printing in an economy like that has the potential to be much, much bigger, much more impactful, much more inflationary. It's weird in an economy like a highly, highly capitalist, private sector driven economy like the United States. The government actually, to some degree, has trouble causing inflation because the demand for money, the demand for real resources is so high because we just make a lot of great stuff. That's really the bottom line in the United States. There's just a lot of really valuable goods and services produced by the U.S. economy. And so the demand for those goods and services is very high. And even when the government prints $5 trillion a year for multiple years in a row, like they did during COVID, they still have a little bit of trouble causing really, really high runaway inflation. We got to 10% year over year, that's frightening and would be catastrophic if continued in perpetuity. But, we're back at 3% or so. So we're kind of like right back where we were. And that's reflective largely of the fact that the underlying private sector is just so productive, creates so much value. There's so much demand for US dollars to access those goods and services that it's actually somewhat hard for the US government to create really high inflation. And so I think context matters a lot. And then you get into like the demographic discussion and the inequality discussion. And those are other, sort of disinflationary drivers and I think the crucial takeaway from all of this is that the causality is very important in the context of these discussions, where you can't just look at the amount of money the government is spending or printing every year and say, that's going to drive inflation in an economy like the United States. That might be a lot more true in an economy like Somalia, or even, some developed European economies, where they're not quite as productive. But in the case of the United States, I think that you have to look at the context of it and then, ask yourself, well, is government money issuance the dominant driver of prices? It certainly causes some inflation, some level of inflation. But we know that, for instance, over the last 50 years, the debt to GDP ratio has increased from, 30% to 120%. And that whole time, the rate of inflation mostly went down, with the exception of COVID, really, when they did print huge amounts of money, the rate of inflation has mostly gone down, despite the fact that the government has become seemingly much, much more involved in the economy. And so you have to ask yourself, why is that happening? Why has that transpired? And I think the answer is that, well, you've got this hugely productive private sector. We've had a huge tech boom now for 25 years going on, and you've got really terrible demographic trends for the most part. And you've got wealth inequality. And when you sum all that together, I think the conclusion is that yes, the government causes inflation and the national debt is a worry in that context, but it hasn't been as catastrophic as people have expected, maybe because you've had these other great big offsets.
How about Dalio's idea of a debt crisis? I mean, do you think there's anything to that we could be at risk, in the next 3 to 5 years of like a debt crisis?
He made like the classic economist error of making a prediction and attaching a time horizon to it, which, if you're, for people who are out there making predictions, you never want to do that, because then people are able to come back in 3 years and say, see, you're a dumbass, basically. So always keep it kind of vague, but I do that sometimes actually, because I'm also probably a dumbass, but
Well, it's funny, like the doom and gloomers though on YouTube, they learned your lesson there, because they'll call for the crisis, but they won't necessarily tell you when it's coming.
Oh,
And so they can point back to like 12 years ago, I called for a crisis, and here's this crisis that I called for 12 years ago.
Yeah. So I'll go on record and say there's not going to be a debt crisis. There's not going to be a debt heart attack, and it's not going to happen in the next 3 years. I really strongly believe it's not going to happen in the next 3 years, because, I actually think that, gosh, we're the reserve currency by such a huge margin. We're the dominant global economy by such a huge margin, that I don't see how the demand for government debt is going to wane rapidly in such a short time horizon, unless the government, if the government was doing what they did during COVID and had continued it, I think there would be some validity to this. And that's the kicker. I think what Dalio is really doing is he's really making a high inflation prediction, which to some people might sound different than a debt crisis, but it's really not. If there was a debt crisis, if there was collapsing demand for the government's debt, you would see that's falling demand for U.S. government assets functionally, which is inherently, that's rising inflation. It's a falling foreign exchange rate relative to others. And so that's very, very much an inflation crisis. And I don't see the scenario where that happens. In fact, I would probably be more inclined to take the other side of that, where, especially with the coming AI boom, or the emerging AI boom, I would say that the likelihood of low inflation, potentially very, very low inflation, is much, much higher than the likelihood of very, very high inflation. Just because, I think in the macroeconomic context, the potential for AI to be massively disinflationary is, I think, a continuation of the long-term disinflationary trend that we've seen over the course of the last 25 years that started with the internet boom and now is, I think, gaining a huge amount of momentum in the way that AI is developing.
We're going to get in the AI boom in a second, because I have like a ton of questions around that. But just one more on this idea that foreign investors would sell their debt. Like, you hear that a lot as like a big risk. And people have talked about maybe when the tariffs got taken off, or the bigger tariffs got taken off, it was because of some signs of this type of thing. Is that something anybody should be worried about?
On the fringe, maybe, but again, I think this is something where I think causality matters a lot. Why does a foreign investor end up with dollars that need to be reallocated to treasury bonds, for instance? It's because they want dollars. They want to trade with Americans. And by virtue of trading with Americans, they end up with the dollars. And so China, for instance, China has huge hordes of US dollars that they end up with. Why? Because they like doing business with the wealthiest consumer in the entire world. And so that consumer sends them a lot of dollars. Their central bank ends up with a whole, big bucket full of dollars that need to be reallocated. And they need to decide, what are they going to do? Are they going to buy, US stocks with it? Are they going to buy US bonds? Personally, like, I don't think this has nearly as much of a bearing on the whole inflation and interest rate discussion as a lot of people think, because their demand for dollars is evident in the fact that they have the dollars in the first place. So whether they decide to reallocate those dollars into treasury bonds, or whether they decide to keep them, in the central bank reserves at the Central Bank of Japan, or the Bank of China, or whatever, who cares? Like if they don't want to reallocate their dollars and earn interest from the US government on those dollars, I don't think we care that much. What matters much more so is the fact that China wants to do business with US consumers. And that's the thing that is driving demand for dollars ultimately, and ultimately contributing to what the future rate of inflation is going to be. Because that's the bigger worry with something like tariffs, is that does tariffs diminish the demand to do business with the United States and then cause the United States to have to put upward pressure on domestic prices in lots of different ways because there's no foreign demand to do business with U.S. consumers anymore? That's a much bigger worry on the inflation front for me, that rather than the idea that, oh, the central bank ended up with a whole bunch of dollars because we do a lot of trade with China. And will they or will they not reallocate those dollars back into treasury bills or treasury bonds or whatever? So I think, again, causality matters. So I think that the worry of China not buying bonds in the future is probably vastly overblown. It's far, far more important that there's demand for these instruments in the real economy, at the point where prices are really set, where we sell goods and services.
I guess we're just going to lob all the political footballs at you today because we're going to move on to immigration while we're at it here. But we don't want to get at it from the perspective of politics, because whatever we're doing and whether we should be doing it, it's a different discussion. But clearly what we're doing has economic implications. And I've been thinking about that a lot in terms of this reduction in the labor force, what it means for the economy, what it means for wages, what it means for inflation. So I'm just wondering if you could maybe take a step back and talk about that and how that might factor into what's going on.
Well, it's really important in the context of the demographic trends, I think, because one of the things that has, I think, kept the demographic story somewhat resilient in the United States is the fact that we do have a lot of immigration. Foreigners want to move to the United States, and that's been an offset to a larger degree to the fact that we have this, slowing population growth, and we have an aging population. And so we haven't had quite the sort of catastrophic demographic decline that, say, a country like Japan has had, because we're much more open to immigration than a country like Japan is. And so it's important in the context of that. It's so messy, because you get into the debate about, are immigrants going to steal jobs from people who were born here and things like that. And, I don't have opinions on stuff like that. Those are just such messy debates that I don't have the understanding or the knowledge to even really get into. And it's probably such a microeconomic debate to begin with that it's just impossible to unravel. But I think from a general macroeconomic perspective, immigration is good in the sense that if you have a demographic problem, immigration will help offset that. And so it's another factor, I think, that plays into that sort of disinflationary narrative, where the extent to which we are, I think, impeding immigration, it increases the likelihood that you will have a sort of disinflationary tendency in the economy, because you just won't have the demand in the economy to buy all the things that we are producing.
Yeah, it was interesting. We had Eric Packman on recently, and he had some charts about this, and I had no idea about this. I mean, the U.S. population growth, like the U.S. born population growth, has been massively in the older demographic. And, we would have a pretty big hole in there if, the foreign born growth has been a significant part of what's been going on. And if we didn't have that, we would have had a significant hole, like looking back to the last decade.
Yeah, I mean, you can argue that, especially in the last, 4 years, this has been one of the things that a lot of economists have said was actually causing the stickiness in inflation, or contributing to the stickiness in inflation, is that you had this huge influx of immigrants in the United States in the post-COVID period that added to this. So, yeah, this is such a microeconomic debate. Like I'm a big advocate, for instance, of, I don't necessarily think open borders are a good idea. But for instance, I think if somebody comes to college here for 4 years and graduates, and we invest all this time and money into educating that person, and we've developed them into this highly skilled worker, I mean, I'm of the camp that says that person should get an immigration stamp, upon, receipt of their degree. Like that's the sort of thing that sort of seems like a no-brainer to me. Whereas like what do you do with the person that crossed the border illegally and is trying to save their family from, the drug cartels in Mexico? It's like, oh, that's you get into a much messier debate about stuff like that. So I don't know. I don't have really, really informed or strong opinions on the overall immigration thing, but I do think that from a macroeconomic perspective, yeah, it's another headwind.
How about the aging population you talked about before, the demographics? Like, how significant is that an issue as we move going forward? Like, what would be the impacts on the economy of the fact that our population is aging?
It's a really important one because old people don't consume as much as young people. And I think that the kicker in this is that you have to look at the context again, where what we have in the United States is a lot of wealth inequality. And so the young people are the ones with the higher propensity to consume, but they don't have the money and they don't have the income. And the older people are the ones with all the money and the lower propensity to consume. And so when you combine those ingredients, that's why I believe the demographic trend in the United States is highly disinflationary, or has this, it's a headwind to rising inflation in the long run. And that's another one that, I don't see a quick resolution to that. I don't see a reasonable solution to it at all. And I think it's most evident in the housing market right now, where you see, the frustration for young people who, if you're not in the housing market already, you feel locked out. You feel like this economy has not served you well. And I think that frustration is totally, totally valid. And who has all the money? Who was the beneficiary of all this? It was people who owned the assets, the older people who had bought houses, 10, 20, 30 years ago, who locked into low interest rates. And now, it's the young people now who they want to buy a house. They have that desire to consume housing, and they don't have the income, and the affordability is not there. And so, that's, again, it's one of these big, big drivers of what has caused the rate of inflation to come down in the last few years. It's that young people can't buy a house, and it doesn't look like that situation is getting better in the short term.
I want to shift back to AI, Alan. You mentioned that before, because this is something I think about a lot. Like, I know in my own life, I've gained a lot of productivity, and I know you've become a pro coder now. You mentioned before we started recording, and like that's what a lot of us are seeing. I mean, I think we're able to do these things that we just weren't able to do. We're becoming more productive as people, but I have a hard time carrying that up and thinking about like, what did that mean for an economy? So I was hoping you could help me with that part of it. Like, how would you expect AI to impact the economy as we move forward?
It's frightening me increasingly, I would say. Like, I kind of had that aha moment where, like a year ago, I was going to hire a CFP to work for me, and I was going to hire someone that hopefully would have like tangentially either marketing and sort of like tech skills, coding, stuff like that. And, I scrapped those ideas as soon as I figured out that, everything that I don't know on the fringe of financial planning, I immediately know now, because I know all the right questions to ask. I understand all of the estate planning and financial planning questions just well enough to not be a certified financial planner, but now I know the right questions to ask to prompt GPT to get me to answers that, frankly, I think are probably much better than CFPs. I mean, I used to, when I had a really, random financial planning question, I had a list of 3 to 5 people who I would always reach out to. And frankly, I probably will, sorry if one of you is watching this, but I will probably never ask you a question again, because I think that the answers are going to be better from GPT and Grok and all the different AIs that I've been using. And I get that answer instantaneous. It's incredibly thorough. And that's a really frightening world to be entering, because I think that there's an element to this where I think that certain executives and high level management probably turns into sort of super workers because they're now leveraging this tool where they almost have this like super assistant with them all the time. It is frightening, I think, for anybody in sort of upper level, upper middle management. Certainly anyone who is in a skilled employment position where these jobs are easily replicated by, a chat bot or, even, just anything that is sort of service oriented. I mean, God, like I think this industry, I think the financial advisory industry is potentially in for a humongously rude awakening in the next 5 to 10 years, where the number of necessary financial advisors is going to go down, I think, a whole lot, because I think that especially for big firms that are bloated with tons of CFPs and analysts and, people who do things that these technologies do really well, those firms have a ton of bloat right now. And so, if I was a big investment bank, I think you're in a really, really tough situation. If you're more entrepreneurial, you're more adept at adapting to this sort of technology and leveraging that technology to make your firm higher growth, more efficient. You're probably in a much better position. But I think overall, from a macroeconomic perspective, I think that the thing that is frightening about AI that is very, very different from past technological booms is that this is happening very, very, very fast. And I mean, like I said, a year ago, I would have hired these other people. 6 months ago, I would have said that the future of this industry is financial planning. You have got to be investing in financial planners because that's where the value add is. It's not in the investment management. It's in the estate planning and the human touch of financial planning. I would argue that was, maybe not entirely wrong, but that was largely wrong. I would, if a young financial advisor came to me and said, should I get my CFP now? I would maybe say no, because I'm not sure that in 2, 3, 5 years, if the CFP designation is going to be that valuable, because I don't think that CFPs are necessarily going to be able to do the job of financial planning better than GPT CFP will. That's a really frightening sort of environment. I mean, imagine someone who, like, this is how crazy it's changing. 3 years ago, the consensus narrative was learn to code. So if you were graduating from high school 3 years ago and you took the consensus advice from all of the experts, you talked to all the smartest people in Silicon Valley, and they were all saying, learn to code. You got to learn how to code in the future. If you can't navigate code, you're screwed. You're graduating this year or next year with a degree that arguably is worthless. And you're a really highly skilled person. You're probably super smart and ambitious. You listen to all the smartest people. And 3 years later, that degree is something that a lot of software companies are looking at now. They're like, we're not hiring software engineers now. Like, that's not what we're leaning into, because the ability to code now has become, much more universal and certainly leveraged by the real experts in a way that is, you just can't compete with. So, but this is happening really, really fast. And I think that's the thing that makes this different, is that, in the 1920s, when the automobile is invented and, starts to become more mainstream, that's a hugely transformative technology that changes the way we start to do everything in the economy. But the adoption rate is so slow because the production of the automobiles is slow and they're expensive and not everybody can afford them. And so the transition from, horse-drawn carriage to the automobile is slow. And that's important because all those people that were related to anything involving horses, they all learned new skills. They learned how to drive a car. They learned how to do the things that were necessary. This is different because you can't just learn everything that GPT knows and then pretend to be that same level of employee. And so this is happening much, much faster. And I think the ability for people to adapt and evolve, especially much, much older workers, I think that's it's really frightening. And I think that we're still, I mean, we are really, really, really early in this too. That's the other thing that, sort of hard to, I think, acknowledge in all of this, is that the market valuations may not be consistent with that. But I think in terms of just where this is going in the long run, I mean, this is we are still scratching sort of the surface of this, because the really, really big game changer is when robotics takes off. When robotics takes off, and then the software is built into actual sort of humanoid or robotic devices that are leveraging that, that's a total game changer, because those things then are actually they're not just doing the service work, they're potentially doing all of the physical work too at that point. And in that environment, these are things that they're doing the work 24/7. They never turn off. They never stop making stuff. And that's a world where you have humongous abundance of everything, and the ability to compete with those things in an employment perspective is impossible or limited, certainly far, far worse than it is now. And so, yeah, I don't know where this is going. The time horizon is the tricky part. Is this gonna happen? Are we gonna have robots like that in 5 years? Is it gonna be 30 years? It may take a really long time for, things like that to happen. Like I was, thinking about this the other day, that when you pick up a cup, a robot still can't gauge really well how much fluid is in this cup. Like, how fast does that thing have to pick up the cup to actually pick it up and do it well? It's still, we're not at a point where it can do really adept things like that really well. And so we're probably still a relatively long ways away from this having the enormous macroeconomic impact that I'm most worried about. But I do think that is coming. I think that world is going to come, and I don't know what sort of world my daughters are going to live in, because I think that the technology that they are going to have when they are adults is going to be so different than the technology that we have that we think is advanced. And I think that that's like the craziest thing about AI, is that it's not just a replicator in the way that it produces stuff over time, and the robots will produce stuff over time. It's self-replicating in and of itself. And so there's a world in which all of this becomes decentralized in a way where we all have our own AIs. And there is no, that's kind of the most interesting outcome in the scope of a lot of people talk about the God AI, that is, they're going to be like a Google of the AI outcomes. And there's a world in which there is no big winner. Maybe it's like the hardware providers to some degree, but even in that world, you could see a world where it scales down so fast that we all have our own personalized, sort of data systems at home, and we all are running our own robotic systems off of those systems. The AI system that they run is decentralized in a sense that it's not the GPT system, it's the Cullen Roche system at some point, and it evolved the way I want it to evolve. It evolves into what I want it to evolve in, and it does what I want it to do. And that's like the really, really scary world. The world in which we're all just surrounded by robots who are doing everything we want them to do for us.
The Justin and Jack AI can podcast with each other. Get you on, Colin.
I'm hoping that's not where we go to here, because we got one of the last things that might still exist in the world of AI here with the podcasting.
It is interesting. There's a company that's backed by Amazon. I forget. I saw them on CNBC, but it was something like taking movies and then having AI be able to produce, imagine if, the AI could watch a movie and then individuals could prompt the AI to create all these different offshoots of the movie ending. So you could have a movie come out on a weekend, and then by Sunday night, there's tens of thousands of people that are posting these ending of movies and maybe even collaborating in different ways. It's kind of crazy when you think about it.
Yeah, that's an example I was thinking of. By the way, we definitely need that, because somebody has to come in and redo the final season of Game of Thrones so we finally get a good ending to that.
I agree.
But I was thinking about that in the context of the value of workers, and I think this is something that this has the potential to be the biggest exacerbator of wealth inequality that we have ever seen in the context of think of it in the context of movies, for instance, where the movie production companies, first of all, the actual producers of these movies virtually starts to go away. Everybody who works in the back scenes, the cameramen, the people who do editing and everything like that, all these people start to lose their jobs. But then the actors themselves, you could have a world in the future where the only couple of actors who are relevant in a movie are the people like Tom Cruise. Tom Cruise does a movie. Tom Cruise becomes much, much more valuable because the name is what sells the movie. And everybody else in the movie is just, CGI. They're just a technology. All the people who are standing in the background, all the actors that Tom interacts with, they're all just fake. But Tom Cruise makes a lot more money in that world because Tom Cruise is the one his name is the one selling the movie. It's the thing that, people don't want to see Mission Impossible without Tom Cruise in it. They want to see Mission Impossible because Tom Cruise is in it. And he's kind of the big draw. And so that's sort of a metaphor really for like the way that a lot of this is going to play out, in the sense that the people who are the most valuable become more valuable, and the people who are in the middle and, at the lower rungs, they kind of just get swept to the side because the technology can do everything that they're doing and it's going to do it better than they're doing it. But the technology can't be Tom Cruise. And that's the thing that at a human level, we still, that thing is not going to go away. We are always going to have a demand for these really unique, special people who stand out and we deem as valuable because, they are Tom Cruise or whoever it might be in certain industries.
As we kind of get towards the end here, I just want to give us a little time to talk about defined duration investing. And I think we're going to have you on in a couple months to talk about this, probably at more detailed level, given some developments that you have coming on with new products that are coming to the market. But let's just kind of, set it up, talk about it just generally. So how would you define or explain how would you define? How would you explain defined duration investing to your average investor?
So I've always struggled with the actual asset allocation as it pertains to a financial plan. Because I traverse both worlds, and I always have over the course of my career, where I try to be a portfolio manager for people, but I also am at my core a financial planner and a financial advisor. I start everything from a financial planning process. And so I've always had this sort of, almost felt like I had like a conflict of interest at times where I was running portfolios that, from a traditional sort of portfolio management perspective, the way that we all traditionally build portfolios is we try to optimize everything for the amount of risk we're taking. You want to get the most return for the lowest amount of risk. And that's the core of the vast majority of investment strategies. And that's not the way that your average investor actually thinks. Your average investor doesn't care. They don't think in style boxes and value and growth and things like that. They think in time horizons. They think in terms of, am I going to be able to pay for this vacation? Am I going to be able to pay for my daughter's wedding? Can I buy a wedding ring? Do I have enough money to send my kids to college? Do I have enough money to retire in 30 years? That's how your average person thinks. And that's what we call an asset liability matching methodology, where the investor is thinking across time horizons and they want certainty of consumption across time horizons. And so when we think of our portfolios, when you think of, does risk optimization apply this concept well and give the underlying investor certainty? No, because they can't understand, is my portfolio risk optimized? The vast majority of professionals don't even know if that portfolio is actually risk optimized. We can look at the historical data and kind of make assumptions that it might be, but we can't know for certain. But the asset liability matching process, and what I call a defined duration process, is trying to actually quantify the duration. So we're defining the durations of certain instruments, and then we are working from the financial planning side of everything, where we're then assessing what are the underlying liabilities and expenses that correspond to someone's budget over different time horizons? And then can we match assets to that portfolio in a way where we're giving this person certainty across time horizons? So, if you've got, let's say you have a daughter that's getting married in 12 months. Well, what's an asset that corresponds to that? Well, it certainly can't be the stock market, because the stock market won't give you certainty inside of 12 months. The stock market is this I call it a very long duration instrument. It's, in my methodology, it's on average, the global stock market is like a 17-year instrument. It's way too long term to give you certainty inside of a period of 17 minutes or 17 months or whatever it might be. It's an inherently more long-term instrument that it gives us a high degree of predictability over very long time horizons. But the stock market is a terrible principal stability instrument. It doesn't give you a lot of short-term certainty. And so the defined duration concept would look at this and say, well, the instrument that you have to match to that is something like a treasury bill. You could take a treasury bill and you can perfectly match that to the date of your daughter's wedding. And you can say, okay, I'm going to take $50,000. I'm going to invest it in a 12-month treasury bill. And I know that when that thing matures, I will earn 4% over the duration of that instrument's lifetime. And I will have exactly this amount of money to then pay for the wedding. And I will have earned a little bit of interest along the way, would have done better than if I was holding, the money in the bank or something like that. And what I've done is sort of quantified this sequentially, where you've taken not just the stock market and treasury bills, but also multi-asset instruments, actually mixed them together, and you can quantify the duration then across all these different time horizons. And then you can go through the financial plan and you can actually match them, and you can say, okay, well, it's appropriate to hold a big, huge slug of stocks, but those are long-term instruments. Those correspond to our retirement goals, and retirement goals are usually big chunks of people's assets in the long run. But to understand their ability to consume in the more short-term periods, you have to use different corresponding short-term instruments. And so what I've tried to do is basically quantify all of this in a way where you can then match it with a financial planning process that corresponds to really the way that people actually think about the way their financial planning works. And rather than giving them this, sort of methodology of, well, here's a diversified portfolio. It might look roughly like a 60-40. We think it's risk optimized. We think it matches with your behavioral risk profile. But we have no idea really if it's going to mesh with all of your financial plans across different time horizons. We hope that it will. It probably will. It might. But we haven't actually quantified it and then bucketed it in a way where we're being very, very precise about it. And that's the kind of impetus of the whole strategy, is to make this more quantifiable and build it out into a sort of a bucketing style strategy that is much more rigorously quantified, so that financial planners and advisors can then take this and apply it in a way where the client actually understands it in a very, very tangible and understandable manner.
Would it be fair or unfair to say that that's similar to like a target date fund? Is there similarities there with that?
It totally is. I would argue that target date funds are the things that come closest to doing this. I think that the difference here is that what I'm doing, and my one critique of target date funds would be that target date funds they're a big blob of assets. They target a specific long-term time horizon, but they're very specifically for that long time horizon. They are not best suited for any other time horizon, really. So when you're planning for 30 years out, I think the glide path that a target date fund follows makes a ton of sense. It's going to give you a lot of certainty, probably at the point where you actually need it. The problem is that it leaves a whole bunch of other buckets empty. And the only way to actually fill those buckets and understand how those buckets correspond to your financial plan is you actually need to disaggregate the target date fund, because the target date fund probably owns things like treasury bills and 5-year bonds inside of it, but you don't have access to those short-term instruments inside of it. So you can't, let's say that you own a 2050 target date fund, but for some reason you needed the money in 2040, or you needed you retire early, you get a pension payout or something like that, whatever it might be. You end up retiring early, all of a sudden, you can't actually access all the short-term instruments that are inside of that target date fund. And if the target date fund is in the midst of a big drawdown or something like that, well, you better have other assets that can correspond to your ability to consume now that you're retiring earlier than expected. So that's the only, I generally love target date funds. So I'm not really, I don't want to sound too critical of them, but the one knock on them is that they're diversified funds that, in a manner similar to like a 60/40 fund, they solve a lot of the problems, but they create this homogeneous portfolio risk where you don't have access to the specific assets when you might need them. And that's, I think, the thing that people most desire about a financial planning process is they want to know, okay, if I got cancer next year and I had to ride out a $100,000 nightmare, do I have the ability to do that? And your target date fund doesn't solve that problem. You need to disaggregate everything into a much more sequentially bucketed process.
We're going to have you on in a few months once there's a book you've been working on where you are looking at a whole bunch of different investment strategies and talking about those strategies in layman terms, and then talking about what goes into them and what type of investor might be attracted to those strategies. But I'm curious, is there anything, sort of little teaser here, was there any strategy that you weren't aware of that you were like, whoa, this strategy just stands out like above the rest? Or was there any strategy that you were aware of that when you kind of did a deeper dive on it, you were like, you know what, this strategy is maybe more robust than I thought it was? I'm just wondering if there's anything that really jumps out at you as a little teaser here. We're going to talk about this in much more detail when the book comes out and we have you back on, but I just figured I'd ask that in closing here.
Yeah, I'll talk about two really quickly. The one that I did study more in depth that the data is so incredibly robust on is Harry Brown's permanent portfolio. I've always sort of liked all weather strategies, but I was actually, I wrote also about risk parity, which is sort of one of the original all weather. It's Ray Dalio's all weather strategy. And the actual implementations of that are really hard to implement, first of all. And the live ones have not done very well compared to, the sort of theoretical commentary, because the underlying commentary behind something like risk parity seems like such an obvious no-duh sort of portfolio strategy to follow, but the actual real-life implementations have not done very well, whereas something much simpler, a Harry Brown-style permanent portfolio, has done really, really well. There's weaknesses in it because it's arguably like too simplified, especially in the sense that like it owns a big slug of gold and probably not enough equities. But overall, I was shocked at the metrics from a portfolio like that when compared to something much more sophisticated, much fancier sounding like the risk parity portfolio. But the one in the book that I actually was the most sort of excited to write about was what I called the forward cap portfolio, which was an original portfolio that I came up with, where I used all these macroeconomic trends, these sort of 5 sort of mega trends that I discussed. And what I quantified in them was the size of the future market capitalization of the global stock market. And so it was really cool coming up with this idea because I wanted to come up with, I didn't want to just write about a whole bunch of portfolios that people already know about. I wanted to write about some original ideas that might be useful for people. And this is a really aggressive, really long-term sort of forward-thinking portfolio, but I quantified the future market capitalization with the goal of sort of skating to where the puck might be going. Because right now, when you buy something like the S&P 500, you're buying something where the puck is moving, but you're basically skating with the puck. You're basically taking the market capitalization over time as it changes, and there's a certain sense to which that is forward-looking, in the same sense that the skater with the puck is forward-looking, but you're not skating to where the puck is going to be. And that's the goal of this. And so there were little things where like, I actually calculated that the future market capitalization of the technology sector is going to be like 40%. So kind of going back to what we were talking about before, the tech sector already is a huge, huge chunk of the market cap of something like the global stock market. And in this analysis, it's going to get way, way bigger. So there's going to be, every company is going to be sort of a pseudo tech company in over a 50-year time horizon. And so that was a cool one, not only because I thought it was cool because I came up with it, but I thought in terms of like a forward-looking sort of strategy, this is the way that if you wanted to be really, really aggressive, this is the way that you should be thinking about the way the markets are going to discount certain things in the future. But what was even cooler was that I took this portfolio and without knowing what the performance would look like or knowing what the actual instruments that go into it would look like, I plugged in all these different instruments into it and I ran the back test and the numbers are crazy on it. And this is a global portfolio that outperforms the US stock market, which was the most shocking thing because I was like, I ran it. I actually, in the book, I benchmark it against the US stock market because I thought the performance was so good that I was like, okay, you gotta benchmark this against the best of the best, right? But when you benchmark it against the global stock market, it like beats the pants off of it. And so I was really surprised by that. And it was a fun one to create, just coming up with the 5 sort of mega macro trends and then applying them in this sort of data-centric manner to extrapolate out the future market capitalizations. But then actually I show investors how to actually implement each portfolio. So you can go in and you can actually buy your own forward cap portfolio using this exact methodology and using the instruments that I actually show in the book. So that was one I was really sort of excited about just because I thought it was a cool sort of macroeconomic concept that's related to a lot of the big narratives that I oftentimes talk about, but I don't always give people, I give people a recipe sometimes, but not necessarily like the actual ingredients to utilize the recipe. And this was a cool one because it outlines exactly how to implement it. So it'll probably go down like 90% in the next big
Right.
bubble collapse or whatever.
No, that's cool though. It's like an investment strategy cookbook. Well, we're looking forward to sort of working through that with you once it's out. And so thank you very much, Cullen. This has been great. Really appreciate it.
Cool. Great talking with you guys. Thanks for having me.
Thank you for tuning into this episode. If you found this discussion interesting and valuable, please subscribe on your favorite audio platform or on YouTube. You can also follow all the podcasts in the Excess Returns Network at excessreturnspod.com. If you have any feedback or questions, you can contact us at excessreturnspod@gmail.com.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of the firms of the hosts or their clients.